Hello and welcome to this episode of UTS Startups Confessions. My name's Harry Godber. I'm co-CEO of the Spark Festival. Spark Festival is the largest startup network in Australia, and we work to connect the various parts of the startup ecosystem, from founders to corporate innovators to investors, policymakers and academics, to help build the glue that helps startups develop, scale, attract investment throughout Australia. We've been holding events recently that take 100 or so entrepreneurs who are looking to seek investment, Series A and later, and put them in a room together with a few investors to get to know each other, hear about each other's perspectives, and learn. One of the ones that we did recently was with a group of family offices, and the response that we got from that event made us think that maybe it would be a good idea to open up the audience to all comers at UTS Startups here and bring along one of the expert advisors who has been working with us to help everybody understand the perspectives of family office investors and the attitudes that they take towards equity investments in early stage. And that's why I am pleased to be joined today by Matthew Downing, who's the principal of Ethium Wealth. Matt, do you want to tell us a bit about you, your business, and the work that you do with your clients?
Sure, thanks Harry. So I set up Ethium in 2019. It's a financial services business. We predominantly work with family offices to invest in funds as well as private companies on behalf of them. We typically do the early stage, the Series A, on the venture side. Predominantly ag tech, fintech has been our focus the past couple of years. Prior to that, I had a software business called Social Boast, which was a more sort of bare bones version of what Hootsuite is, and I sold that to a group up in Singapore. Did some study and travel overseas, and then thought there was an opportunity essentially to set up a business where you could be a conduit for family offices, high net worths that wanted to access opportunities that they otherwise wouldn't come across.
So how enthusiastic are family offices and high net worths when it comes to investing in the startup ecosystem? And what are the sorts of envelope sizes and like stages of companies that they tend to look at?
Yeah, I think, like any kind of ecosystem, it does depend. It depends on the size of the family, it depends on when they made their money as well. What I see as typical is a lot of the first generation family offices that might have had a startup business themselves and had a liquidity event, is that they typically will then set up a family office that's focused on investing in businesses and companies in the industry where they've made their wealth. If they're an older style family office and they're second, third, fourth generation, they're usually more diversified. They trend towards more institutional approach. Last 2 years, there's a lot of talk around reduced valuations in venture world. And while a lot of venture capital funds have been more sheepish, I would say a lot of families are actually, because they are cashed up, have actually been taking a lot of direct opportunities in startups. So there's definitely, plenty of activity there.
So what does that mean for a founder? Because it is quite opaque a world of investment. It's a world of family offices, and every office is by nature very unique in the way that it approaches risk, industries, and kind of investment philosophies. But it is at the same time quite common to find a family office on a cap table of someone who's raising capital at any stage. How do those sorts of relationships come about?
Yeah, typically there's the 3 Fs is kind of how people raise money: friends, family and fools, essentially in the beginning. So sometimes you'll see a family office that will result essentially from a personal network. But there's also plenty of people that run businesses that don't have those existing deep family office networks, particularly if they've moved countries or they've just grown up in an area where those groups are less prevalent. I would say, we're unique to live in a time in human history where, you have access to technology, even LinkedIn, and a variety of different sources where you're actually able to curate databases of people and then actually just outreach. I know a lot of people say that you shouldn't maybe cold outreach or send a cold email, but a lot of families I talk to, some of them I've even built relationships with based off sending a cold email. So there is definitely merit in that. The only thing I would say with that component is that you do want to be targeted. You don't want to send out a bulk email to 500 people. essentially asking for investment, but sort of understanding what they've invested in, the industries that are relevant, and then you make a short list, and then you can be tactful in how you approach them.
So tact, privacy, respectfulness, what I'm hearing that are key factors towards approaching families and high net worths as a founder. How does that differ from the way that founders might be used to approaching VC?
I'd say most VC funds are actually funded by family offices. So as in even though they've got an institutional framework around them, typically it's been former founders that have made a bunch of cash, and they've usually seeded the fund, and they've got families behind them. And I'd say very good VC funds are very founder friendly. They're usually quite public on their website in terms of approach. These are kinds of deals we look at. There is an increased number of families that do that on their website. I would say the ones that aren't doing that, that essentially a way a founder can go about approaching them is that if you identified a certain family, let's say we're based in Sydney, and you knew that they'd invested in a certain kind of company, I would actually get in touch with that company they've invested in and ask them about their experience with that investor. And more often than not, if they share and it's a positive experience, they're usually pretty happy to do a warm intro in that way. So.
Is this often a situation of investors moving in packs as well? Do they tend to be lead investors? They tend to follow on, or tend to sort of form conglomerates?
Yeah, I see a lot of cap tables, outside venture in other kind of real estate projects we do as well, where it might not even be that great a deal, but because a family that's well known has invested in it, you'll sometimes get a bit of a pack mentality. So, very successful fundraisers who are founders are able to be able to activate that network effect. We view family offices in psychological and philosophical groups. So as in if you see one type of family in a certain deal, you'll often see 3 or 4 of the same usual culprits. And to be tactful is you identify who that influential family is, you'll cultivate the relationship with them, and then you'll get the rest for a round. And just very quickly, I think typically you'll have larger families, so like north of $1 billion will lead rounds. But then I see it as not very common at all. Even obviously, 500 million is a little bit of cash, but they're less kind of enthusiastic about leading rounds, and that's largely based off that if you think about 500 mil individually on a personal level is a lot of money, but when you're setting up a family office, you might have 3 or 4 people in your back office that you're paying. From their perspective, they cannot do the deep due diligence that a VC fund with 10, 15, 20 people or a larger family office can do. So they will lean off the due diligence process of another group.
I'm really interested in digging further into this taxonomy of different types of families and their philosophies. Typically, and Australia is one of the largest private wealth pools in the world, right? And it is typically invested into some mix of listed, unlisted equities, debt, fixed income. Why does VC play such a proportionally significant role for so many families? What is the intent? Is it around trying to make a difference? Is it around trying to distinguish their investment approach against others?
I think with older families, so the second gen, when the kids or the offspring take over the wealth, they're usually more bullish on venture. Because philosophically, from their perspective, they want to carve out their own niche in the world. They don't just want to invest essentially what their parents or grandparents have invested in. So you do see a higher trend and increase of those kinds of people allocating capital. As a percentage, you sort of group it in equities, real estate, mix of fixed income. Venture sits under the alternatives bucket, where they're also investing in like PE funds and other broader alternatives. I think as well there's also what I just call they just like the idea sometimes as well, and they can afford even more so than a VC fund to invest. A VC fund has to report to a whole series of LPs. They've sort of represented that they've got to make certain returns. They're charging certain management fees, performance fees. While a family, they're just reporting to themselves at the end of the day. So it is sometimes there is just you could have a coffee with someone, they really like the idea, it's right timing, and it works quite well.
Yeah, and you also see a lot of people who might have sold companies that they founded themselves and then want to invest more in ideas in the particular verticals they're experts in.
Yeah, I think it depends. It depends on what. So if someone sold their business for, let's say 100 mils, they've had an exit but not a ridiculously crazy exit, it's still a good amount of money. Then there, it depends on where they're at in life. I mean, even things of like, do they have kids? Do they, they've bought a couple of properties and done those kinds of things. And then, if they might want to be more risk off as well, because they've founded a startup which is sort of much higher on the risk spectrum, and they might want to be more risk off. So, they only want to invest then in new businesses that, essentially where they can add strategic value, add beyond just the check. But if they're at another stage of life, then I think they do diversify out. Just from a numbers perspective, which might be helpful. So 15 years ago in Australia, there was 6,000 like ultra high net worths in Australia. So that's people with over 30 mil minus their primary house. That's tripled in 15 years. But the vast majority of them are essentially self-made people that have largely built money through property, but also a variety of other investments. But those people, I see a trend, they're very open and receptive to investing in the next generation of businesses and startups. It's just access, really.
So on that access point, what are some sort of do's and don'ts for those in the audience when it comes to approach?
Yeah, I think, I had an upbringing in Sydney that you could term as sort of upper middle class upbringing per se, and had a little bit of a network, but didn't really grow up in it. And the way I was able to develop the network was that it was through university peers, as well as the startup that I'd sold to a family group, and then they were able to kind of connect me with others. I think if you're starting from zero, which is more common than not, I think it's as simple as essentially going through. It depends how much effort you want to put into it, but going through all the newspaper articles where every single investor has invested in a business in your industry, and you make a huge laundry list of your wish list investors. You narrow that down based off a range of different parameters of size and scale. And then, I've done more audacious things where, there's emails, there's phone calls, there's turning up to their office, so unannounced. But I would say, you've definitely got to do that in a certain way. You wouldn't want to come across as, but there's sort of, depending on the nature of your personality, you can sometimes get away with those things.
Generally, a warm intro in those circumstances works better, right?
Yeah, I think so. But then also some families reward the hustle, because they themselves have been self-made business people, and they've done those things and been more audacious. I mean, a warm intro is always great. It always makes it a lot easier. But the reality is you can't always get a warm intro.
Do you think in terms of the value that investors see in a founder in this space, is there more focus on personality than there would be elsewhere?
In the sense of a family deciding on investing? Yeah. I think there's often people on a personal level are investing in founders where they'll see a part of themselves in it. If there's more of that, if it's like the head of a family. If you're dealing with like the particular alternatives manager, then I'd say it's more an institutional process. But it depends on what life cycle you're at. It's sort of like if you're pre-revenue and your product's just post MVP, what are you investing in? You're really investing in that person at the end of the day, and your belief that they can execute on what they're claiming they can do.
So we've spoken a lot about Australia, but the majority of your business is actually overseas, isn't it? How does Australia's market of private wealth compare to that of Singapore, for example, where you do a lot of work? Our business majority based out of Singapore. So I can put the same amount of effort in Singapore to raise 5 mil from one family than essentially to raise 500,000 in Australia. So I'd say, and that's essentially why we skew up a bit in Singapore. And I think that's just a factor of education. We're on the cycle. I mean, Singapore is very much a market economy. They're sort of a Switzerland of Asia in the sense of how they position themselves, and they're very globally focused. While Australia, we have a lot of wealth, and we've made that in a variety of ways, but we're still young. Like even our oldest family office is only 4 generations in Australia. You go to Europe, you go to Japan, and they go back like 12, 13, 14 generations. We're still quite a young country. And I think from an identity standpoint as well, we're still coming to,
and I won't get too philosophical, but so we're still trying to understand like who we are as a nation, I think, in terms of how we perform globally. Like it's quite fragmented is my view, and that doesn't mean there's not great innovation and great founders. I just think it's an education piece that we're in the middle of.
What sorts of risk factors do you think are taken perhaps more conservatively in Australia than elsewhere? Is it regulatory? Is it sort of purely commercial business model? Are people more embracing of like wild ideas in a place like Singapore?
I think in Australia, largely wealth generation has been rewarded not off productive capital, but off having a balance sheet. So if you have a bit of money, you'll typically invest in property because it's essentially a surefire way to multiply your wealth. And that's been rewarded largely by legislation in Australia over the past number of decades. And from an incentive structure to invest in early stage startups, there's been different initiatives like ASIC and different things that have been positive, but there hasn't, I would say, been an overwhelming consensus of we want to be an innovation economy. It's been posited at different points by different leaders, but I wouldn't say not executed on in a meaningful way. While in Singapore, they're a small island nation. They have to result off trade, essentially. And that's largely they've made themselves a structured economy where a lot of inflows of capital that have come from China through Hong Kong have moved to Singapore because it's a safe region, and they have to invest and deploy. That's the incentive structure of that nation, which I'd say the incentive structure of Australia is more on sort of primary industry. And continuing to subdivide property. So.
Yes,
but
trying to foster that kind of innovation embracing, risk embracing mindset is core to the work that we've been doing with Spark Festival. You came along and spoke at a forum the other day with a couple of family offices and got to meet some really interesting, unique investors who are kind of later stage in the scaling and capital raising journey. What were your sort of reflections on that experience and the value that creates for both the investors who are in that room and the founders?
Well, yeah, I mean, first of all, I was surprised by the quality of companies in the room. And I'm definitely not a skeptic, but in terms of what they've been able to do with limited funding is exceptional. And I think from scarcity, sometimes great things happen. So that was very impressive. And then talking with the two families that were there afterwards as well, they were also exceptionally impressed. And often, sometimes families, you can become a bit isolated because you can become a bit, everyone's always hitting you up and, essentially asking you for money. But they were like, wow, it was a really, really highly curated group. And I think I met up with a couple of them afterwards as we're, potentially looking at a few things of what they're doing. And the level of technicality and innovation, particularly of some of them that spun out of universities, was unlike anything I've seen. So yeah,
absolutely,
it's quite cool.
What about our core missions at Spark Festival to try and help people get exposure to those sorts of investors who are really genuinely enthusiastic about idea creation and commercialization in this country? So if you're a founder and you're interested in being part of these forums, we hold them every couple of months with a different group of interesting investors, which span private equity, corporate venture capital, the kind of conventional VC circles, and family offices and private wealth. So anyone who's interested, head over to sparkfestival.co, which is our website. You can sign up to a mailing list, and we email out calls for EOIs for these events every couple of months. They do sell out very fast. I think the last one went in about 3 hours. But the enthusiasm to be in that room on both the investor and the investee side is incredible, and we absolutely love it. We're going to be doing a lot more of these, both through the Spark Investment Network, which is the bi-monthly event series, but also through Spark Festival Week itself, which this year will be in the first week of September. And we're really excited to be bringing that to you all. I just want to thank you and thank Ethium Wealth for your support of Spark Festival. Of course, I want to thank UTS Startups for hosting us today. And I also want to thank our supporters at Spark Festival, without whose financial support we wouldn't be able to put on this series of events. Investment New South Wales, who have been core supporters to our events in Sydney and regional New South Wales. The Department of Industry, Science and Resources in the federal government, and Minister Ed Husic, who administers it, as well as our partners at Stone&Chalk, Herbert Freehills, ACS and others who've been joining us in helping bring the Australian innovation ecosystem alive. Thank you very much for joining us, and hope to see you in the next one.